The S&P 500 is a favorite with many investors all over the world because it gives you access to some of the largest companies, including the likes of Apple, Microsoft, Google, and Tesla, and many others. So in this video, we'll be looking at some data to see how it compares to a global index fund, and you will see very shocking results here. A portfolio made up of only small cap stocks, since these are meant to outperform in the long term due to their growth potential, and a few more popular portfolio strategies. But we aren't going to compare it to any individual stocks and shares, as then we enter a totally different world of investing. We're testing these portfolios with index funds across the wider stock market. First up, we have the S&P 500 against the entire US stock market, and then as the third benchmark, we'll be using a traditional 60-40 portfolio made up of 60% the total US stock market and 40% global bonds. And what we'll do is go back as far as we can in history, or at least as far as the data allows us, for the fund or ETF that we'll be selecting. I'm going to be using this portfolio backtesting tool, which lets me use only American funds, but we do have alternative versions here in the UK. And I'm going to assume we invest $10,000, which could easily be 10,000 pounds or whatever currency you want. And of course, we're going to reinvest dividends. Let's look at some figures, and I'm actually going to put up the three portfolios here at the same time, as this will make things a lot more interesting. And if we take a look at the performance chart, you'll notice right away that portfolios 1 and 2 are almost identical. These lines represent the S&P 500 and the total US stock market. As you can see here, there are very few differences between the two because of their similar compositions. The S&P 500 includes the biggest 500 companies in the US, which account for approximately 80% of the US stock market. And then the entire US stock market captured these 500 stocks, but also those smaller and mid-cap companies, which make up the remaining 20%. Now, it's no surprise that the 60-40 portfolio hasn't performed as well as the other two all-stock funds, but we kind of expected that, right? Looking more closely at portfolios 1 and 2, they've been quite impressive in terms of their annual growth rates over that time period. We're talking about over 10% return on your investment per year. However, as you can see here, the S&P 500 has performed slightly better than the entire US stock market. And what's interesting is that because these portfolios are so closely aligned in terms of composition, their best and worst years have been pretty similar. But take a look at this max drawdown, which shows the worst falling value of these portfolios over this 30-year time frame. This kind of data really puts things into perspective and makes you ask the tough question. Could you handle a 50% drop in your portfolio and still keep investing? I think many of us would find that very challenging, depending on where we are on our investment journey. Now, here is where the real comparison kicks in, and this is where bonds have historically played a crucial role in balancing our portfolio, especially as we approach the later stages of our investment journey. So portfolio number 3, while its growth hasn't been particularly exciting, still offers a decent return of 8.2%. I'm sure many people would be quite happy with that. However, your worst year with portfolio number 3 hasn't been nearly as bad as portfolios 1 and 2, with a decline of just 20%. This shows that while you'll still take a hit like the rest of the market, it's not as severe, but you can't completely avoid it. Your max drawdown as well, which is likely the most significant factor here, has been only 30%. While a 30% drop is still significant, it's easier to handle compared to a 100% stock portfolio that dropped 50% over the same period. If you look at the graph to see roughly when this happened, we'll notice when the bonds came into play and helped us out. You'll see that the line is slightly flatter overall. For example, if we look at a significant crash like the financial crisis, we would have seen portfolio 1 and 2 down $22,000, while our portfolio number 3 was hovering at about $25,000. We'll also notice here that the last decade or so has been a very important period for stocks, with bonds falling behind. Since around 2011, portfolios 1 and 2 have really taken off, while the 60-40 portfolio has lagged behind. So this first comparison is very interesting. Now, the main takeaway here is that over a long period, even a 60-40 portfolio can deliver solid returns with minimal volatility and less severe drops. This type of portfolio is more suitable for those who are approaching the time when they plan to withdraw money. At the same time, for those of us just starting our investment journey, a 100% stocks portfolio can deliver very strong returns over the long term. However, we need need to be prepared to stomach those significant drops of up to 50% potentially. The good news is that if we are 20 to 30 years away from needing this money, we have time to ride out these tough periods. Okay, moving on, we're going to use the S&P 500 as our benchmark, but we're introducing two new portfolios into the mix. First up, we're adding small cap stocks from the US, and then we'll blend small cap stocks with bonds in a 60-40 ratio. Looking at the numbers, the S&P 500 still leads the pack with an impressive growth rate of over 10%. Coming up just a very close second is our small cap stock index, and as expected, our 60-40 portfolio remains the most conservative option. When we zoom in on the graphs, it's interesting to see that portfolios 1 and 2 were neck and neck until around 2010. But things took a turn in recent years, especially with those big tech and AI companies gaining dominance over smaller ones. What's really surprising is that despite their growth potential, the small cap stocks haven't outperformed the S&P 500 as we might have thought. What we've actually seen is that the small cap index has been slightly more volatile but hasn't necessarily given us back the same returns. Looking at the numbers here, we can see that its best year surpassed the S&P 500 at 45% increase in a year. However, even though its worst year is quite similar, it's important to note that it experienced a maximum drawdown of nearly 54%, slightly higher than the S&P 500's 51%. And our portfolio 3, which mixes bonds with those small caps, helps dial down the ups and downs, making the ride smoother. During tough times, you'll see how our portfolios move together, but portfolio 3 stands out for its stability, thanks to the bonds. However, it might offer slightly lower returns overall. So once again, the S&P 500 takes the crown, but I do still believe that it's worth allocating 5 to 10% of a portfolio to small cap stocks, because you never know what can happen. However, do keep in mind that I am not a financial advisor and this is not a recommendation. It's just my own personal opinion. Okay, now the one comparison that most people will be interested in. We'll be comparing the S&P 500 with a global index fund and the Boglehead 3 Fund Special, famously known as the Lazy Portfolio. But just before we do so, do me a huge favor and hit that subscribe button if you're enjoying this video. It really helps out my small channel. Thank you very much. A little background on the Boglehead portfolio. It's a simple 3-fund approach. You've got exposure to the US market, an international fund, and the bond fund too, to add some stability to the mix. And it's all divided up in a 50-20-30 split. So quick look at the graphs and the numbers. We're only going back to about 2009, so it's still a long-term period, but it's not a crazy amount of time. As you can see, once again, the S&P 500 dominates. I was honestly expecting the global index fund to keep pace more closely, so it's a bit surprising to see it lagging behind by $30,000. And portfolio 3 mirrors the performance of the global index fund quite closely. However, due to the presence of bonds, we see lower returns overall. Looking at this chart, we can easily see that after 2020, the S&P 500 has really detached itself from the rest and is just in a world of its own, with those big tech stocks pushing it higher and higher. In terms of numbers, the S&P 500 has delivered more than 14% per year on average over this 15-year period. The global fund is still decent at 10.7%. If we weren't comparing it to the S&P 500, we'd certainly be celebrating those returns. As for the 3-fund portfolio, it's slightly behind with a 9.8% average annual return, but it's still an excellent return. If you look at these figures in a bit more detail, interestingly, you'll see that they had very similar worst years and max drawdowns. This is quite surprising to see, as we'd expect those bonds to smooth things out a little, but instead you've got similar volatility. Therefore, it's clear that investing exclusively in the S&P 500 has proven to be the most optimal strategy in the past. As long as you can weather those tough market times, the rewards in the end are well worth it. However, as we saw, each of these portfolios has different use cases, meaning that a lot of the answer of which one to go for will depend on where you are in life, how long you have left to invest, and what your level of risk appetite is. Generally speaking, when you're younger with longer time horizons, you have more flexibility to ride out market fluctuations. And in theory, you could lean heavily into stocks, ignoring bonds altogether, and stay focused on consistently investing through all market conditions. Now, as we've seen from almost every portfolio, there will be years or moments where you could see significant drops, possibly even as much as 30, 40, or even 50%. It's during these times that you'll face the tough question of whether you're truly comfortable with those fluctuations. And even if you think you will, trust me, experiencing firsthand is a whole different story from just imagining it. Because the reality is that there are many investors out there who have never really been through a proper market crash. Personally, I'll stick to investing in a global index fund, since the S&P 500 already makes up more than 60% of it anyway. Also, don't forget that we don't know what these graphs are going to look like in the next 20 to 30 years. Maybe the growth will be coming from countries like China or India, you never know. So I think we should just be positioned to take advantage of these potential growth opportunities, wherever they may be. Because the truth is that this is what successful investors do. They hold diversified portfolios and keep investing over the long term. In fact, check out this video next to find out how the ISA millionaires in the UK invest their £20,000 annual allowance and whether there is anything we can learn from them. See you there.